Ladies and gentlemen, good evening. This is Christopher Aaron. It is the 14th of June, 2017. There was a Fed interest rate decision today. They hiked interest rates once again for the fourth time in the last 10 years, 0.25%. Who are these Fed policies benefiting anyway? Let us look at the data. So, once again, the fourth rate hike of the current cycle. For reference, please keep in mind that interest rates remain at 70-year lows, even still at the current range of 1.25%. Interest rates are the same as they were during World War II, for comparison. So the largest international conflict of human history, and the Fed deems it important enough to print sufficient money to keep interest rates at those levels still today. Janet Yellen, chairwoman of the Fed, some of the statements that came out today in the release: inflation has declined recently. Well, how much has it really declined? Let's look at the purchasing power of the US dollar over the last 103 years. Certainly, we can see no sustainable long-term trend reversal in the inflation that is constant around us. What is another statement that was released today in the meeting? The committee currently expects to begin implementing a balance sheet normalization process this year. And of course, looking at the Fed's balance sheet over the last 15 years, we can see what was a pretty straight line and then did this crazy thing in the crash of 2008. Remember this, all the printing of the money going from roughly 900 billion to just under 5 trillion worth of high-powered currency that was printed by the Federal Reserve over just the last 10 years. So if there is some sort of normalization about to happen from this, it's long overdue, but I highly doubt they will be able to do this in any reasonable amount of time, and the Fed balance sheet will probably never get back to where it was pre-credit crisis. Another statement they made today: the labor market has continued to strengthen and economic activity has been rising moderately so far this year. Well, I would say that probably depends on who you ask. If you ask those who benefit from inflation, those with disposable incomes, those who are able to invest in things that benefit from inflation, then you are probably agreeing with this statement. If you fall into the 90% of the rest of the US population and the world population for that matter, you have seen real wages stagnate at best and actually decline for the better part of the last 35 years. So once again, who is she talking about here? Who has benefited and who is seeing a strengthening in the labor market? So basically what we have here is a market that is allowing the Fed to have its cake and eat it too, to use that colloquial term here that we use in American English. Basically what this means, if you're not familiar with this term, it means the Fed has been able to do these incredible quantitative easing and money printing policies, and they are getting away with it. They are absolutely getting away with it, and they have hit the sweet spot that basically most of the world's economies believe now in the power of the Fed. They've done it right. They've printed just enough money to correct the imbalances that had built up in 2008, and now everything is good with all this extra printed money. So we live in a very unprecedented time here. Just remember that this printed money ultimately is for the benefit of the banks. It is not for the benefit of you or I or the majority of the citizens of the world. We are the debt slaves to the banks under the current regime. And this is why I find that it is so important to have a way to protect oneself and to work as hard as possible to attempt to get out of the debt slavery that the Fed would have us put into if they had their way perfectly. There are ways that we can break free of these chains. It requires some outside the box thinking and some hard work for ourselves and for others. This can be done. It also would be good if we stopped taking 20% of our budget and blowing people up on the other side of the planet. That certainly is not helping anyone. Let us look at the action in the precious metals after this Fed announcement. You had a strong rise today, early in New York, and then a complete sell-off, falling back below the opening price today. This was a key reversal day in my mind in the gold market. This does not look good at all. Silver basically doing the same thing, spiking. The spikes this morning happened as a result of the CPI indicators and the labor market figures that came out early on in the morning. This was perceived as negative for the US dollar, and then when the Fed came out and spoke their magic formula, all the precious metals sold completely off. So I believe we live in a absolutely fascinating time right now where basically the Fed has convinced the markets that they are perfectly in control and that there is no need for precious metals. There's no need to worry about the value of the currency. There's no need to worry about the insidious theft of purchasing power that happens against your savings year in and year out. Don't worry. They have everything perfectly under control. And so when we turn to the chart of the gold market here over the last 18 months, this is what I was talking about last week. I did not want to see this. And this looks like the most bearish scenario that I was contemplating last week. Now, this chart only shows the end of the COMEX data here. So this doesn't show that the price came all the way back down below the close from yesterday. So this looks even more bearish. And for that reason, I want to switch over to the GLD fund. So this is the price of gold. This is the paper fund. We're looking at the same thing, same time frame. It's just a different number on the y-axis. This is the GLD fund. And you can see here, this shows the full close through 4 p.m. today, closing underneath the low from yesterday. Now, this was a key reversal day in the gold market where you spike higher and then you move back down below that initial point for the day. You can see that right here. Very high volume coming out of the gold market. The last time that we had a key reversal day like this was on the night of the Trump victory. And we remember the severity of the decline that led to in the following 2 months in the gold market. So this is a bearish sign right here. I would say there is a lot of risk in the precious metals over the short and the intermediate run. And here is where it is so critical to really do some self-reflection. And mind you, when I say that this is a bearish signal, I am talking with the part of my investment portfolio, with the part of my capital that is more short and intermediate term oriented. So even though, for example, I've taken some hedges over the last couple of weeks, I've actually bought some puts to protect myself. If that's something that you are interested in, please send me an email. I can try to help you if it's appropriate for you to do something like that. So that is some of the short-term action that I'm talking about here. It looks like the price of gold could be coming back. I think the first test is 1230. If it fails below 1230, we'll be looking at this rising trend line, which would come right around 1150 right now, and I would not want to see that broken. Although this is a very bearish signal. Now, mind you, at the same time that I am saying that this is very bearish and I'm taking some precautions across the precious metals, I have in the last week bought some physical gold and silver for my long-term accumulation strategy. So I think the most important thing, because we're in this consolidation here, the most important thing is to not take an all or nothing approach. I think what the Fed is attempting to do here is to scare everyone out of the precious metals, and there could be a significant decline to come. And I think when this final decline happens, that will likely mark the bottom for this bear market. That said, there could be some significant losses to come here over the next several weeks, several months. The leading indicator that I was looking at over the last several months, this has been going out to premium subscribers on a weekly basis. We've been looking at the gold miners falling at each of these successive highs, 1, 2, 3 lower highs amidst 3 higher highs in the price of gold. Basically a double top here in gold over the last couple of months. But so here is your warning signals, and then we had a big dump in the miners today. Technically speaking, this is still a consolidation in the GDX. You can see this here between 21 and you have to call it 25.75. This is still a consolidation, but you can see the downward bias. You have a flat line here for the support. You have a downward bias here. There are some other trend lines that subscribers will know that I'm looking at right now to watch, but I don't like the look of this at all. Okay, so do not shoot the messenger. All I'm telling you is what I see on the charts. Turning back to the gold market. If there's one thing that I want to make clear, it's that I understand the fundamentals behind the theft and the corruption that is ongoing in central banks and in world governments. I see that, and that is why my physical metal is not for sale if prices go lower at this point, because I have a long-term perspective and I want to be accumulating. I think the gold market is in the process of putting in a multi-year bottom. But that said, a multi-year bottom could include a retest of this 2015 low. It could even include a new nominal low in the price of gold, and that would severely impact some of the miners that are borderline in their cash flow at this point. You would not want to be sitting on JNUG if we get a retest of the December 2015 low. So I understand the fundamentals, but that said, I'm going to call the market as I see it. I hope if there's one thing I have made clear here, it's that I let the market tell me what is happening. And right now, with the parabolic movements that we're seeing in the technology stocks, in the cryptocurrencies, in the S&P 500, in certain bubble-like real estate markets such as Vancouver and Toronto and a few others, the market, the precious metals market, is basically just suffering from apathy at this point. It's like there's so much money going into so many different markets that we're seeing this real struggle here. You know, we're seeing struggling on the way up, and we are seeing every time there's something such as the meeting today that came out with the Fed where they indicate that the market is healthy, that the labor market is healthy, you just see traders sell all their short-term precious metals positions. And ultimately, they have succeeded over the short run. We have to admit this Fed has done an amazing job, not at solving the problems with the economy, but in convincing people that they have solved the problems with the economy. And ultimately, what we are talking about here is a psychological phenomenon. Confidence. What is the confidence right now? Right now, the Fed has the market's confidence. We know fundamentally that they are robbing us for the benefit of their member banks primarily, but that does not stop the fact that over the short run, they seem to have succeeded in convincing the market that they know what they are doing. So, we have to be somewhat cautious in the precious metals, especially in leveraged positions. All the investments that I'm making go out to premium subscribers. I lay out everything that's happening every single week that is impacting my trading desk here and the thoughts that go through making the decisions that we are making. We cover gold, silver, the GDX, individual miners. We cover the US dollar. We cover the commodity markets. We're looking at everything to try to pinpoint when this market is going to turn. And I'll tell you one thing. If it's not right now, and if we have to wait on the sidelines for another 12 months or so after this for a final decline to occur, I predict the exact same thing is going to happen that happened a year and a half ago. Watch some of the videos that I was making a year and a half ago trying to warn people that this turn was coming. And we saw that phenomenal rise in the beginning of 2016. Most people were not prepared for it. Most people did not want to get involved in this sector until it had already moved up 100 or 130%. So I would tell you that if you understand the fundamentals, but you also understand that over the short run, the psychology of the market is the most important thing. And therefore, we have to follow the technical analysis. We have to actually follow when is this market going to turn. I suggest you stay tuned because we are going to identify the turning points in these markets here over a long-term basis. If it doesn't come sooner here, I predict there will probably be a final washout at some point later this year or into early 2018, and the cycle will begin again. If you have a unique situation that you would like an independent perspective on, I do work with individuals via Skype and via phone. I thank you very much for watching. I will see you this time next week.